Hi all. So I thought since these the concepts that we are going to discuss today are quite evolving and quite new to at least some of us, I thought it would be good to give a quick introduction to what we are going to talk about, so that we can have a meaningful interaction post that. So the first topic is on the pillar one, which is about the reallocation of taxing rights uh, to market jurisdictions. That is where the services are, our products are consumed. Um, so the OECD, after the 2015 BEPS 1.0 framework, they started working on addressing the concerns about the digital economy. They started focusing on the big tech companies to ensure that their profits are fairly allocated to jurisdictions where the services are consumed. But as time progressed by 2021, the focus really shifted to, that sector-based ring fencing was removed, and it actually started focusing on the biggest and the largest and the most profitable entities, the 100 multinational groups globally. So what it achieves is to ensure that the super profits made by these groups are allocated to the market jurisdictions in a with a formulary approach. Um, just bear with me because you can see the field there. Yeah. Yeah, so it's basically applies to MNEs with a consolidated global revenue of more than 20 billion, and with a profit of, with a PBT of more than 10%. So there are two elements to pillar one. One is amount A and amount B. Amount B is about allocating the excess profits to the market jurisdictions, whereas amount B is not directly related to amount A, but it is just a standard approach to remunerating baseline routine marketing and distribution activities. So it's basically a TP concept. Okay. So the steps involved: first, define the pre-tax profit above 10% margin, and then 25% of that excess over 10% is allocated to market jurisdictions. Um, uh, there is also certain thresholds, like, for example, if a particular jurisdiction has revenue of less than 1 million, that is excluded, and then there are certain allocation rules based on which the profits are allocated. Now, some of the conditions around that is, the applicable or the EAF members who are signing up to Pillar One are expected to actually do away with the digital services taxes gradually, and also to, if in case there are any unilateral measures in future, they are also supposed to reconcile via a conference of the parties, for dispute resolution. When I'm talking about the current status is actually stalled because of the political differences. There are ongoing disagreements, including for countries like India, Mexico, Colombia, etc., and Brazil. There are ongoing differences for the market jurisdictions, and then also there is a lack of the U.S. legislative approval, which also actually holding the implementation of Pillar One. As a result of that, the other concept, Pillar Two, that is going ahead. Okay. There is some political agreement to put a moratorium on the existing DSTs. As you may be aware, there are existing DSTs in UK, France, Italy, Spain, etc. India has recently abolished it. Some of these countries have agreed to a transitional approach, but that deadline was December 24. That is already over. Okay. In October 23, OECD has already published a multilateral convention to implement Amount A, which requires ratification by at least 30 states, housing at least 60% of the ultimate parent entities of the MNCs in scope. Okay, but since since there are still political disagreements, that that process has not moved on since then. Okay. OECD issued a final report on Amount B in February 24. But again, or it has also incorporated the concepts of Amount B in the OECD transfer pricing guidelines 2022. Just moving to the next concept, that is pillar 2. This is about reallocating. Sorry. Yeah. Yeah. So pillar 2 is about ensuring that the multinational groups, the qualifying multinational groups, pay a minimum of 15% on their taxes in each jurisdiction where they operate. Okay, the objective is to address unfair tax competition and to avoid tax as the biggest incentive for shifting operations to low tax jurisdictions. So Pillar 2 applies to again to groups exceeding 750 million of threshold, and it has got two rules basically. One is the Globi rules, which applies the top-up tax of 15%, which includes IAR as well as UTPR. UTPR is a backstop rule. Okay, in case IAR is not able to take care of all the top-up taxes, then UTPR kicks in. Then there is also a subject to tax rule, which is basically about allowing the source country to retain some of the taxing rights. So far, about 57 countries have implemented the Pillar 2 in one form or the other. India is not one of them, but there are announcements that India started working on a framework. The process includes a lot of data gathering, calculation, local registrations, and filing of returns. The earliest of the return coming up somewhere by June 26, and then most of the returns are due by June 27. September 26, and with a few coming also due by June 26. Just moving to the next topic on next slide on Pillar 2. It's basically about how Pillar 2 is calculated. You can find this it's also in the OECD, the OECD commentary, and also the model rules, the appendices. It's basically identifying an adjusted PBT and the covered taxes with some calculations as referred to in the model rules, and calculating the ETR based on that, and then and see what is the shortfall compared to the 15% of minimum rate. While applying that shortfall, you also get a substance-based carve-out, meaning from the globe income that you identified above, you will also be able to reduce a substance based on the payroll cost and the tangible assets located in a particular jurisdiction. Mind you, it applies on the basis of a jurisdictional blending, unlike the US GILTI, which applies a global blending concept. So on the shortfall, on the excess profit, after reducing the substance, top-up tax rate is applied, and that is supposed to be first paid by the UPE. In case the UPE has not implemented IAR, then it will be paid by the next UPE, and so on and so forth. Whatever is left remaining will be tackled under the UTPR. Okay. Next topic is on ESG and responsible tax function. This is again an evolving concept, as you are aware. So it's basically about the three dimensions, ensuring it's a framework that measures the company's sustainability and ethical impact across the environmental, social, and governance dimensions. This is an evolving, still at nascent stages, though we have taken various initiatives for some of the top listed companies by SEBI and RBI climate disclosures, etc. in our country. But if you compare our status to the global, we are still at a nascent stage. So I have just included a comparison for your reference. Talking specifically about India's transition from a fossil fuel subsidies to a carbon taxation regime, we historically used to subsidize fossil fuels. However, in 2010, coal cess was introduced, And then subsequently, we also increased, by 2014, we also increased the excise duties on petrol, etc., effectively imposing implicit carbon pricing. And as of now, we are also working on a formal carbon pricing policy, whereby which we plan to launch, whereby we plan to launch carbon credit trading systems scheme by 2026. That's all as an introduction from my side. And in the interest of time, we will quickly move to the panel discussion. So, Piyush, the first question is to you. We discussed about uh, Pillar One. How do you think the reallocation of taxing rights under Pillar One will impact the multinational companies generally?
Thanks, Biju, and hello everyone. Thanks for the introduction. I think you've already explained what Pillar One is, so I'll just quickly summarize it. I think Pillar One was basically intended to move the source-based taxation to a more consumption or market jurisdiction-based taxation, specifically for MNEs, and to tackle MNEs operating in today's technological environment, where you don't really need physical or employee presence to interact or act in a market jurisdiction. That was the intent of Pillar One, trying to tackle or trying to address all these issues around tech businesses and how they operate and don't pay taxes in jurisdictions where their market exists, one of the biggest ones being India. As you mentioned rightly, the current status, I mean, while it was supposed to allocate or redistribute the taxing rights to market jurisdictions, the current status of Pillar One, honestly, in one word, is actually it is dead. There's no consensus around it. There's no discussion around it. There were two big stakeholders in it. One were the MNEs, or the countries where the big MNEs are located, with a turnover of more than $20 billion, 20 billion euros, and having substantial tech businesses. We all know where they are, primarily in the US, and US is not even participating or engaging in these discussions. The other side of it were stakeholders like India and market jurisdictions, where the end consumer sits, who are going to probably benefit out of Pillar Two. For them, from Pillar One, for them, Pillar One and Pillar Two was like a combined deal. And now, when with no action happening on Pillar One, effectively they are kind of abandoning Pillar Two as well. Case in point, again, being India. India has been very vocal and clear that for India, Pillar One and Pillar Two was always a combined deal. And with Pillar One actually being non-existent, Pillar Two is hard. In my personal opinion, is not really going to see the light of the day in India. So while the intention was right, but I think the political consensus on Pillar One is not going to be there. So that's my take on Pillar One, honestly.
Okay, thank you, Piyush. Yeah, so thanks for those insights. Talking more broadly about it, even the US, to get the US Congress approval itself is a big concern as far as the US, engaging more into Pillar One. When we talk about, say, jurisdictions like India, India has got concerns about the arbitration process. So generally, we have been very resistant to global international arbitration. We want to protect our rights to decide our taxes. So which is one of the main concepts in Pillar One. The other one is, of course, we are concerned about whether countries will go withholding, because Pillar One, the amount, it's about allocation of profit. So some of the MNEs also may be making losses. So that way we won't get that share. In future, whether there will be any kind of pressure to actually give away our right for withholding taxes is also one of the main concerns as far as countries like India are concerned. Just going to a related topic on the significant economic presence concept introduced by Finance Act 2018, okay, which is also which is also one of the core principles underlining the thoughts about Pillar One. So, Shallu, what are the challenges that will arise when defining active presence or significant economic activity in a globalized world?
Thank you so much. So I believe earlier it was very easy to define the active presence or significant economic activity, but now with the globalization and digitalization, it has become very difficult because at this point of time, companies can earn revenue in one country while sitting in another country. So it becomes very difficult that which country will tax them, and moreover, there are no physical offices. Profit can earn from IPs, brands, right? And they are not limited to one country, they can grow multifold. So in this era, it becomes very difficult that which country will tax on what part, right? For example, moreover, there is no common definition for the same. Some countries says that you should give us the taxes on the basis of number of users. Some says that you should tax on the basis of transactions. Some says that etc and etc. So there is no common platform, there is no common definition, so it becomes very difficult, and there is a risk of double taxation.
Yeah.
So, and moreover, the value creation comes from various countries. It is not restricted to only one part of the world. So it also become a challenge to
Yeah.
tax the income and to tax the profit.
Yeah.
And with the challenge, there must be solutions as well. So there are so
Okay.
many solutions which Pawan would.
Yeah. Pawan, would you like to?
Yeah, so thank you, Salu. I think rightly said, Salu, because active presence is now related, is not relevant to the physical offices. Is now is a consumer base. So market driven. So wherever your market is, from there the pillar one is applicable. So basically, adding to the Salu point, there is one more challenges after the AI also. So let's say suppose the company is set up in a US, and that year the content is using someone European country. So and the user of the AI is in India. So it's a valid questions in the department that from where this value creation is coming from this AI also. So this is very difficult for the to decide from where this value creation is created and how to we tax it. So this is also one of the challenges in that. So and every country, when DCT is applied, so every country interpret the significant economic activity in a different manner. So India is on the basis of the user and the revenue, some country basis of the user and the platform user. So there is no standard global definition of the this significant economic activity. So what happened in this DCT case, that every company that this is significant and wanted to tax, and one global profit they are taxing. So double taxation risk is created there also. So with that, OECD in pillar one is suggesting a solution that rather than replace the physical presence, it lets we will talk about the on a revenue base. So let's decide a threshold. So it's a company. The pillar one has suggested a global threshold for company like a euro 20 billion, and the company which has a 1 million euro, and basis of that, if the company reach that threshold, and that company if reach the threshold, then company will taxable in that country. And same way, there is one challenges also. So when you talk about the data privacy and the tax verification actually, so let's say suppose a department ask about the user base to define your calculations and all that, but the DPDP and GDPR say that we cannot share the data user. So that's what the one problem is also. To reduce this conflict of the data privacy, what the OECD suggests is that let's talk about the tax on the basis of the revenue which earned by that country. So that's what the solution OECD is the second solution they actually. And same way OECD also suggests, because if we are planning to a pillar one going to be implemented, and to the local country to avoid this revenue DCT that have planned. So let's in a DTA to eliminate all the DCT in a single timeline. So that's what the one second solution, and that way the challenges will be pillar one is suggested. That's my take is.
Yeah, agreed. So SCP, though was introduced by Finance Act 18, is still not being applied. It's kept as almost dormant. One reason is that it's still a negotiation tool, but there are a lot of restrictions in applying it because of the overriding nature of the treaties, etc. So pillar one will provide a solution to that if implemented. But as Piyush rightly said, it is still so distant, before it sees the light probably. Okay, so now recently with the Finance Act 2025, so we have rolled back the equalization levy, and so now that that means that we are getting there's a revenue shortage, and before pillar one get implemented, there will be some losses. So Mahesh, and so the next question is to you. How can tax professionals prepare for the DST rollback and shift to a unified global consensus via pillar one in an efficient and effective manner?
As I said, as my colleague said, the pillar one may not see the consensus. So what's happening in pillar one? The taxes are moving from, say, USA to the market jurisdictions like countries like India, which in current political environment is very unlikely that any consensus will reach. So what other countries are doing? I mean, the countries want their share on the digital presence, some taxes on that. They are introducing digital service tax, DST. And DST is levied on the revenue. Like India also introduced 6% levy, so-called like Google tax, which was rolled back last time. 2% levy is still there, which is called equalization levy. So similar taxes are there in the European countries, similar taxes are there in Canada. And what I see, these kind of tax maybe more and more countries may introduce so that they can protect their right on taxing these kind of transactions. So what as a taxpayer we should do if DST is there in some countries and we are a multinational company, have presence in multiple countries? I will say let's map out what all the countries where the DSTs are there, what sort of revenues we generate from those countries, create a sort of a heat map, understand what the implications on the organization. Once that is done, let's review their agreements in those countries, whether those agreements need any revisions. Because generally the agreements are entered by the sales team and the tax team are least involved on those agreements. Whether the amount which we receive need to be grossed up, like there's a 3%, 2% DST in some of the countries, and that tax need to be paid, and that's an additional burden or additional cost to the organization. Can that be recovered? Your pricing strategies in those countries, that should be different from those countries where DST is not there. Can we increase the price in those countries by 2%, 3% so that DSTs can be recovered? Even your accounting also. In accounting, can we account for DST as a separate tax other than your corporate income tax so that it can be seen as a separate item and can be controlled, like how much DST we are paying, which countries we are paying, and it can be controlled better. So I think these are the steps which an organization we can take and maybe mitigate DST, and DST will remain because the consensus is unlikely to be reached. Maybe it's a dead animal, I will say. Yeah, and DST will be more and more prevalent. Maybe India has withdrawn 6% equalization levy. We never know, it may come tomorrow again. And many more countries, even for the Indian kind of multinational companies, we'll see DST is coming in many more and more countries.
Yeah. The EU, even the EU had threatened somewhere. They wanted to introduce. They discussed about having an EU DST levy, and even countries like Belgium has been trying to implement it for many years now, but just stopped because of the pillar one expectations. But as you said, it may never happen, and it all will come back again. Yeah.
Yeah, let's draw a plan around it. I mean, how to mitigate it.
Yeah.
That's
Piyush,
all.
would you like to pitch?
I just wanted to give a very quick perspective on this. See, pillar one, in my view, was really the most important spoke in the wheel because that is the need of the hour. what does the world want? That with the change in business models, with the advent of technology, new ways of doing business, it's the market jurisdictions which are really not getting their fair share of the revenue. This was being tackled through unilateral DSTs or through introduction of things like significant economic presence. And that is where Pillar 1 was very important, that it will bring some kind of uniformity. Now with Pillar 1 effectively being in a limbo, more and more countries will start implementing these unilateral levies. And that is where it's going to be challenging for businesses and tax professionals alike. That now you have to deal with different regulations in each country. And rules will differ. So like India, with our size, we may have a different threshold. A European or a LATAM country with their size may have a different threshold. And the other thing around these DSTs are that there's no clarity or there's no certainty around their credibility. Generally, in a taxation world, whenever these taxes are, you get credits under tax treaties. That's what they're for.
Yeah.
But with DSTs coming around, like it was the case with equalization levy, which was in India, there's no clarity on how they will basically be creditable. So
Yeah.
that's where all these challenges will arise. India possibly, in my personal opinion, abolished equalization levy because it wasn't really generating the revenue it was intended.
Yeah.
So it was just creating an unnecessary compliance burden in my view. So that's it. Thank you.
Okay. Thank you. Thank you, Piyush and Mahesh. So the next question is to you, Pawan, and Piyush, you can also pitch in. How are tax leaders addressing the overlap between DSTs, gross-based digital taxes, and the OECD move towards Pillar 1 if that happens?
I think Piyush and Mahesh ji ne, we have covered almost in the DST things. So only with the consenting of the time, I would say that the tax leaders is now basically is looking and actively engaging with the local finance ministers and the industry group that whenever you will a DST, let's decide on the consistent time to remove this GST. And also there could be a provision in the Pillar 1 to provide this DST relief also. So that's what the first thing. And second thing, because whenever DST and the Pillar 1 will come, because many country has still DST and Pillar 1 will come, so it will be very difficult to simultaneously run, and double taxation risk is there. So there is a need for basically implementations of and nowadays now at time in ERP there is no kind of a system that you can track all these country wise or business line wise revenue, okay, audit trail, so that you can prove that your department also. So there is also need to be build a good ERP systems to track this all better manner. So that's what because India has moved, India has eliminated GST just as PS, but many countries is still applying this. So that way, I think a solution is that first that they are approaching engaging industry groups to eliminate DST in one go, and they provide a relief in Pillar 1 also. So that's what my
Yeah,
idea is.
yeah. Yeah, you mentioned about data, whether it be Pillar 1 or Pillar 2. One of the biggest challenge that we see is in respect of the data, especially for a big multinational setup. Okay, so that is one thing again, and one has to prepare for in case Pillar 1 becomes a reality, say a couple of years down the line also, then the biggest challenge is going to be the data. Okay. So just moving to Pillar 2, I mean, again, this is a point that we have sufficiently covered. Going to Pillar 2, which is about the minimum tax of 15%. Okay. So Mahesh, can you give an overview of Pillar 2? How will it impact the profit allocation and the holding structures in the future?
So Pillar 2 is a minimum 15% tax, and it's shifting the entire taxation strategies from locational arbitrage to where the substance is. It's like substance-based tax. So the low tax jurisdictions, if we set up any legal entities or we have multiple holding companies in between, so all those things need to be re-looked into. For example, like if you have entity in say Dubai or Mauritius and the substance is less, but those were created just to have the tax arbitrage, may not be tomorrow those will be taxed in some manner. right? But there are opportunities also because the way tax is computed in Pillar 2 is different than what we compute generally in our computation of tax, right? So it's a jurisdictional based computation, not legal entity wise tax. Suppose in India you have 4 legal entities and Pillar 2 is implemented, so all 4 legal entities put together will be seen. And if suppose one have lower tax, another have higher tax, so that blending is still possible. I mean, these are the way the things can be redesigned. The legal entity structure should be streamlined. Maybe the multi-layering of the legal entities should be reduced. Now coming on the incentives, whether the incentive is as a covered tax, because the definition of tax is also different in Pillar 2. So the incentive, if it is covered, maybe let's advocate with the government. Can they change the kind of incentive from covered tax to non-covered tax? Let's take an example like gift cities in India, which is exempt today, right? If Pillar 2 is implemented, that will also be subject to minimum tax. Can that be converted into, say, cash subsidies or any other kind of subsidies? So these kind of things need to be worked upon by the companies.
Okay. Yeah. I mean, we have got some time constraints and we are relatively a big panel. So, Gaurav, how can the Pillar 2 implementation is moving from concept to reality with the global adoption and the US kind of, resistance moving, more complexity to it. So, can you share some thoughts from your side?
Sure. Thanks a lot, Biju. So I think before we do the crystal gazing, I think it's important to analyze what has happened in the past 6 months in Pillar 2 world. Like Piyush mentioned, there's a Pillar 1 is almost, we don't know what's going to happen with Pillar 1, but Pillar 2 is also going through its own journey. Back in, I would say, somewhere in June, US introduced a section called 899, right, which was basically a kind of a target towards all the taxes, all the taxes like UTPR, DST, diverted profit taxes. So the idea was to implement a withholding tax or an additional tax on entities who are levying these taxes, which kind of caused a lot of ripple across the globe. Now, this was a big blow to the OECD program, because having a Pillar 2 tax as well as an 899 would have been a major disaster. The G7 reacted pretty quickly on 28th of June. They came up with a plan where they wanted to carve out US out of the Pillar 2. Now, what does that carve out means? We don't know as of now, but that was the plan, right? Like to come up with a carve out where US can not be part of this Pillar 2 regime. They were supposed to introduce the regulations, or maybe I would say a blueprint, last Friday, but nothing has been introduced as yet. There was a glimpse that came on the OECD portal, which was pulled back in 30 seconds or so. So as of now, do we have, we kind of, is Pillar 2 going to continue? Would the 899 come back? We are not sure. Because China also wants a similar carve out. There are countries who are negotiating on the incentive schemes. Estonia feels that they still have they should also. It's a burdensome thing. So I think in the future, my that's my personal view. Pillar 2 would exist. In what shape or form, we don't know, because the due dates are about to come, the 30th of June and 30th of September for filing of GIR. So I think there would be certain level of compliances that we need to do. So, yeah.
Okay, yeah, just one question. So, Abhishek, please can you talk us through the disclosure requirements relating to Pillar 2? Yeah.
Right, Biju. I think most of my panelists have covered all the questions related to Pillar 2, but the main question is the disclosure, what has to be made. And disclosure is very much dependent the countries who have enacted the law and who have substantially enacted the law, and corresponding the countries where the enactment and substantial enactment has become operative as well. So based on this classification, the disclosure has to be made. The first disclosure which is has to be made, that the application you will have to file, that the disclosure of the deferred taxes along with the reporting of the deferred taxes has to be made. Secondly, you will have to make a quantitative disclosure along with a qualitative disclosure. Under the quantitative disclosure, you will have to mention the average ETR which you have, and what is an amount of profit as in a group you will have and you will be exposed to once this global tax is introduced or applicable on you. You will have to mention that. Along with that, what is in which jurisdiction you are highly impacted. You are operating in the multinational, you are M&E group, and you are operating 27 more about jurisdictions. So you will have to mention which jurisdiction, which entity you are highly impacted. Though I believe this is not a very easy calculation, but still we will have to mention the jurisdictional level disclosure. The last disclosure I would like to cover is that this is for the organization where the operation is that you will have to disclose your current tax expenses, and the impact of the current tax expenses has also to be disclosed over there. So considering the time constraint, I am handing over.
Thank you, Abhishek. Just one quick 1 minute or 30 seconds for you, Rajesh. Moving to ESG, what role can the tax team play in supporting the ESG strategy and reporting and compliance, of course?
Okay, thank you. Though last, but I think the different topic on ESG. So basically, the ESG we would rather take it from the what is happening in India and then match it to what is happening globally. Biju had already explained as to what is happening in globally, which is very much moving. But in India, it is more pushing from the public side. If I say from the public perspective of ESG, so environment, air pollution, and all. We as an Indians are pushing, but nothing happening from the government side. So you can say ESG, the environment is the main issue which is pushing. So the tax team, from their organization point of view, should take into account what are the factors which now the policy makers actually in India are looking into the ESG. For example, very quickly, I would say at the organization level, the government has come up with small initiative as to you should have a CNG generator of a big hospitals like setup. Otherwise, there would be a penalty. You discontinue use of diesel. Then there are smoke guns you have to install in your premises. Then you have a waste management disposable system. Then there is a measurement the government is doing on your ESTP plant. So all those things, though the tax team or the compliance team, I would say in a healthcare setup, would not be aware. So first and foremost thing is the mapping of these compliances, which are essential and necessary. And what would be because many of these compliances are like shutting down of any particular operations. So the compliance team, I would say, should be aware of all these taxes. On the other part, they should also be aware about what are the benefits which you can get to comply with all these things. So if you go for a green energy, if you go for a green OT, even for the bank financing and all, it greatly helps when you give all those compliances, though it is not applicable in India to any trust or any other small sector. It is mostly on the corporates, but yet small initiatives, solar energy, for example, we are going full way into solar energy, the entire setup of 500 bedded hospital. So these are the factors which the compliance as well as the tax team should be aware. Globally, things are moving very fast, but I would say the ESG of environment is more driven by the public world over rather than the government or the leaders. Thank you.
Okay, thank you, Rajesh. I think it was a very good discussion. We have got topics which discussions can go on and on for days, but I think with the time constraints we manage it well. Thank you so much. Thanks all. In case any of you have got any questions, please feel to reach out to us. Thank you.